Okay, now in the forex market, what we're basically doing is that we're trying to forecast, all right, where price is going to go. Okay, now we have price here in the middle of nowhere. Okay, your duty as a trader is to determine if it's going to potentially go up or it's going to go down. So if you want to say, or if you want to determine if price is going to go up in the first market, what do? You buy. Okay, because you're expecting value to appreciate. Then if you want to determine whether the market is going to go down in the first market, you are going to be selling, because you are looking at value depreciation. Okay, when you see something depreciate, it went down. When something appreciate, it went up. So in forex market, if you are in the middle of nowhere, your duty as a trader is to determine where price is going to go. Just like a news or a weather forecaster, you forecast what is going to happen, and 60% of the time it happens that way. It doesn't mean you're going to be right always, but you're going to be wrong. So sorry, you're going to be, at the end of the day, you have a competitive edge. Okay, you must have an edge to stay right in this market. That's to continually make profit. All right, it's a business, and any business that you're not making profit, to me, I believe is no business. All right, so you must have that edge. You must have that strategy that you're using. What is strategy? Strategy is just sets of rules. Okay, it's just sets of rules that has an edge. All right, sets of repeatable rules. Okay, that has an edge over the market. That means you are right at least 50% of the time. All right, you're right 50% of the time. These are sets of rules, exactly what you need to see for you to take a buy or sell decision, because that is the only thing we are looking at in the forex market. We are trying to forecast whether the market is going up or down, and in order to be on an upward bias, you need to be buying. In order to be on a downward bias, you need to be selling, right? So that's just what it is. And now another thing I would like to say is that the market, you can never see a straight move like this in the market. All right, the market moves up by going down and up, going down, up, going down. So we have two kinds of move. All right, we have the impulsive move, which is the move in the direction of the trend. Okay, and then we have a retracement move. We have, this is an impulsive move, they move in the direction, because this is overall an uptrend. Okay, remember I said if the market wants to go up, it doesn't just move in a straight line like this. It doesn't not move in a straight line like this. Okay, if it happens like this, everybody will be making money. But the market, if it wants to move up, it moves up. All right, it makes an impulsive move and it goes down. It makes an impulsive move and goes. But what's the major characteristics of this upward movement is that all market, first of all, I would like to say, has a high and then has a low, right? The highs looks like an N. You see, market was going up, it turned down. Market was going down, it turned up. That's a low. All lows, they look the same. They look like a V. All right. If you look at this low, it's looking like a V. If you look at this high, it's looking like an N. So, but in an uptrend, the market is making sets of higher lows. You see, the difference between this low and this low is that this very low we are looking at here is higher than this low. All right, so it's called a HL, a higher low. All right, now we have a high. I told you all market have highs and low, whether uptrend or downtrend. All right, so now this very high, the difference between this high and this high is that this high is higher than this high. All right, so we call it a HH, which is a higher high. So in an uptrend, the market makes sets of higher highs and higher lows. So now let's talk about a downtrend. That's a downtrend cannot happen in a straight direction like this. Rather, if the market wants to move down, it moves down a little bit. That's an impulsive move. It makes a retracement. Impulsive makes a retracement. Impulsive makes a retracement. Do you know why it makes this retracement? In order to pick up orders. You understand? There's what is called liquidity. If the market, when they say liquid, something is liquid, it means it has money. Money is there's, well, let's say a company is liquid. It means the company has money. All right, it's sustained by money. So if the market has high liquidity, the liquidity of the first market is about 7 trillion. I think it was about $5.4 trillion a day. All right, that's what moves the market. So the market has liquidity. So because of excess liquidity in this market, there are times that the orders are missed. All right, so why the market moves in this direction is that when it makes an impulsive move and finds out that there are some orders that, because of how volatile, because of volatility, some of those orders were not filled, so it tends to go back to pick up those orders and go back in the original direction the market is supposed to make, because this is a downtrend. All right, this is a downtrend. So it goes to take liquidity down, takes liquidity down. That's how it moves. So in a downtrend, we observe that the market is making sets of lower lows and, sorry, this is a lower high, because I told you all market have what, a high and a low. All right, all market have a high and a low. So this is a high and then this is a low. Remember, a high looks like an N, market going up and going down, right? And a low looks like a V, market going down, went up. So this is a high, this is a low, right? This is a lower high, and then this is a lower low. All right, because the difference between this low we are seeing here, all right, and this low is that this very low is lower than this low. So that's why it's called the lower low, and that's how it is. So we know that this market is in a trend. All right. So what most people do that is very wrong is that when they see the market going up, they buy. When they see it going down, they close the buy and enter for a sell. It doesn't work that way, because you see, even in a downward moving market, you still find times that the market will go up a little bit. That's called the retracement move, makes the impulsive move. But if you want to make profit in the forex market, you must be in this long moves, because if you look, the real direction is downward and the impulsive moves are to the downside. That makes it a downtrend. Don't even understand. That's just what it is. So our duty as traders is to instruct our brokers to buy or sell a particular financial asset. They are subject to your instruction. You tell them where you want to enter. Let's say you want to take a buy now. You tell them exactly where you want to enter for your buy. Let's say buy at 1.4. You tell them exactly where you believe would be wrong, which has to be lower, because you are saying buy, and buy means up, right? Buy means that you are forecasting that the market wants to go up. All right, and then you say that if the market does not go up and goes down, then you are setting a stop loss. This is your entry. Okay, this is your entry, while this is your stop loss. You see, you are telling that if I'm wrong, because I bought, and buying means market, you are forecasting that the market wants to go up. I should, if I'm wrong and the market potentially doesn't go up, it goes down rather, I agree that I should lose a certain percentage of my account, which you have been able to calculate using a lot size and whatever way that you use to calculate your loss. All right, you must have determined that, okay, I will lose if the market comes down to this is my stop loss, where it is at 1 point, let's say 3. Don't know if you understand. I should lose $10. It should be minus $10. But if it goes up, because I tell people, before, is the only business that you can determine your loss and your win before it happens. All right, but if it goes up in the direction that I forecasted, I should be booking profit at plus 20. Okay, so the market now is not going in the direction you have forecasted. It rather went down to where you say minus 10, which is at 1.3. All right, which is at 1.3, for example, and it hits 1.3, you have lost $10. But if from your entry where you have determined it goes down but does not hit 1.3 and now later went up and hit your profit, you have given instruction that at say 1.5 or so, let me just give this 1.5, which in figure means plus $20 or so, you should book profit, because you don't know what might happen, whether the thing may turn from there and come back to the downtrend. So you understand, based on a repeatable pattern, based on some sets of rules that are repeatable, sets of repeatable rules, all right, that has an edge. All right, let me write that has an edge. All right, that's what the strategy is. Sets of repeatable rules that has an edge. That's what the strategy is all about. So now I'm going to be showing you a strategy that has sets of repeatable rules that has an edge. That means when you are doing it, you are sure that if you do it 60 times, if you do it 100 times, you should be right at least 60 times. 60% of the times out of 100. Okay? And one wrong thing people always have in mind is that they need to be right 100% of the time. It doesn't happen, and it will never happen. Okay, it's not a perfect business. But if you are right 60% of the time, I'll show you how you can make money. How do you make money when you are right only 60% of the time? It's what is called risk reward. Okay, what is called risk reward. This is a financial philosophy that states how much are you losing, how much are you winning. Like, see in this scenario now, for example, that I said minus $10, right? And then when you are winning plus $20, right? You see. Now, if you continue like this, when you are losing $10. When you are winning $20. If you continue like this, and then you take 100 trades, all right? You take 100 trades. Let's say you lose 60 trades out of that 100. That means minus $10 times 60, right? All right, and then each time you won, because it's not possible to lose every time, right? You now won $20 times 40. Don't you know you will still be profitable? But you were wrong 60% of the time, isn't it? Should we prove that you will still be profitable? What is 10 times 20 times 60? Is that not 600? right? Now 20 times 40 will be what?
800.